The broadcast is now starting. All attendees are in listen-only mode.
Hello, good morning. We are about to start shortly the webinar on disclosure and transparency to scale up sustainable investment. So, good morning, good afternoon, good evening, depending on where you are in the world. Welcome to this webinar on disclosure and transparency to scale up sustainable investment. I am Mustafa Chowdhury, Senior Producer at Climate Action. Thank you for joining us. It's a pleasure to welcome so many listeners to this afternoon's webinar. We have received over 550 registrations, and that's a testament to the excellent speakers who are participating and sharing their thoughts and experiences on this important topic. Please be aware that this session is being recorded and a link will be emailed to you shortly after the webinar is complete. So you will be able to listen to it again and share it with your peers. Before we start the webinar, I'd like to give you some information about Climate Action. Climate Action was established 10 years ago in a unique contractual partnership with the United Nations Environment, which is the world's foremost body on environmental protection and stewardship. Climate Action provides a global media and events platform and establishes and builds partnerships between businesses, governments, investors, financial services industry, and public bodies to accelerate international sustainable development and advance the green economy. Today's webinar takes place ahead of the Sustainable Investment Forum Europe, which takes place on the 13th of March in Paris, and it is one of the only European multi-stakeholder events focused on sustainable investment, with engagement of all key public and private sector organizations, from asset owners to large financial institutions, policymakers to city leaders, to drive sustainable investment and collaboration. The Sustainable Investment Forum is held in official partnership with UNEP Finance Initiative and is the ideal place to meet, network, share ideas, and discuss concrete solutions to the current challenges of European and global climate finance market. Speakers for this year include Nicholas Ackville, CEO of AP4, Eva Halverson, CEO of AP2, Magnus Billing, CEO of Electa Pensions, Naeem Abu Jaoudi, CEO of Candriam Investors Group, Philippe Defossé, CEO of ERAF, Corinne Smith-Ehenacho, Global Head of Ownership Strategies, Norges Bank, and Olivier Guesson, Director General for Financial Stability, Financial Services and Capital Markets, European Commission. To view the full list of speakers, please go to europe.sustainableinvestmentforum.org. This brings me to today's webinar on disclosure and transparency to scale up sustainable investment. With governments and businesses around the world committed to tackling climate change and making the transition to low carbon economy, it is crucial to scale up investment in climate mitigation and adaptation. Many investors already have sustainable investment strategies in place, but there remains a huge communication gap between investors and businesses. In order to encourage the shift from mainstreaming environmental consideration, a standardized and comprehensive set of data needs to be available for investors to improve their decision-making processes. A number of initiatives and guidelines on environmental disclosures already exist throughout the world, some of which are more widely used. Harmonization of data made available to investors is highly needed in order for investors to be able to compare companies or projects they're looking to invest in. The data also needs to be comprehensive and fit certain financial disclosure criteria for an appropriate analysis and better informed investment decisions. Over the next hour, we will explore the following questions and more. I feel extremely privileged to welcome our excellent speakers with significant experience to address this topic. I would like to welcome Wim van Hyfte, Global Head of Responsible Investments and Research, Candriam Investors Group, Faith Ward, Chief Responsible Investment Officer, Brunel Pension Partnership and co-chair of the Transition Pathway Initiative, and Jane Stevenson, Taskforce Engagement Director, CDP. Each speaker will take a few minutes to present their views, following which we will take questions from our listeners. You can submit your questions via Twitter using the hashtag #SynthEU or using the question box on the GoToWebinar bar on the right of your screen. Don't be shy. We will try to get through as many relevant questions as possible in the hour time frame. And with that, I will hand over to our first speaker, Wim, who is going to introduce himself. Wim, would you like to introduce yourself?
Thank you very much, Mustafa. Good evening, good afternoon, good morning. My name is Wim van Hyfte. I'm Global Head of Responsible Investments and Research at Candriam Investors Group. Within the company, I'm responsible for research on environmental, social, and governance issues, and then also the implication for and the integration into portfolio and risk management across assets and across regions. Before heading the Responsible Investments and Research Department, I was Senior Fund Manager and Quantitative Analyst also at Candriam, co-managing our global ESG quant funds and segregated accounts for over 10 years, where I scrutinized and researched how you integrate ESG factors into an equity or fixed income process. Before joining Candriam in 2006, I've worked in the academic world for about 8 years, where I conducted research on mostly empirical research on asset pricing, risk modeling, and portfolio management, but also on corporate finance, venture capital, and business angels. Most of my work was presented at academic conferences, and I'm still active in the academic world. I'm visiting professor at a business school here in Belgium, where I'm teaching on asset pricing in advanced master in quantitative finance. Maybe a little bit about Candriam too. Candriam is an acronym actually that results from polling our company's employees, and it stands for Conviction and Responsibility in Asset Management. We are a multi-specialist asset manager, managing over 110 billion in assets under management across different investment products and solutions, covering 5 key areas, which are fixed income, equities, absolute return, asset allocation solutions, and obviously intertwined with that is a whole set of sustainable investments. We launched our first ESG fund in '96, so we have a very long history in doing ESG research and integrating that into portfolio management. And we actually started our in-house independent ESG research and analysis team in 2005. And since then, we have gradually expanded our experience across asset classes and developed a whole very broad product range that is all based on that independent in-house ESG research. We are also one of the founding signatures of the United Nations Principles for Responsible Investments in 2006. Thank you. Bringing me to the presentation itself. Very briefly, the way I'm going to approach it is obviously disclosure and transparency is very important. We have a very long history in sustainable and responsible investing, and I would like to give you a little overview of why it's important and how we approach it from an ESG analysis perspective. Now, obviously, I do not have to tell you that climate change is very significant, but also one of the most misunderstood risks that companies specifically, but also I think society face as a whole. And I'm not only talking about the severity of the physical effects that we have seen over the last few years that arising from climate change. I'm also talking about the timing, which is a very delicate issue, and the scale, the impact it might have on the different sectors that we invest in. And it's definitely uniquely challenging, certainly because you have to do a lot of estimation, and it's very difficult to comprehend that timing and that scale. So I'm not only talking about the real physical effect, but also about the financial prediction that leads us to another very important topic, which is obviously the risks of transitioning to a low carbon economy. So disclosure and transparency actually serves informed decision making for all stakeholders. We obviously, as an asset manager, take that perspective as an investor serving our clients. But I'm also talking about other stakeholders like lenders, banks, insurance, companies themselves, but also policymakers, legislators, and society as a whole, I think is very important stakeholder for which disclosure and transparency is important. In the end, what is very important is to hold those company key decision makers, boards, corporate executives accountable, meaning that it's very easy to contemplate about climate change and have philosophical discussions about it, but it's also about now 10 years later looking back and conclude that some maybe executive or board members stubbornly deny the impact of climate change on their business model and their business. So for us, disclosure and transparency is a key element of good governance and trust. Now, for investors, for us, I think the most important thing that we should keep in mind here is informed investment decision making. In relation to what we do is obviously efficient capital allocation and also financial and non-financial performance monitoring. And in that regard, what is very important is less information means less certainty. And I would like to refer to, on the right side, to a picture of the Financial Accounting Foundation on accounting standards, a picture they're already using a long before everybody was talking about sustainability and climate change, where you see like the green on the right top, better information. It all starts with better information. And that is exactly what climate change and also the Taskforce for climate-related financial disclosure was really about, because that leads to greater transparency, better financing decision, and increased investor confidence. The last two bullet points I want to make here, what is very important, and I will make the link to our process, is the materiality. It's also, from a legal perspective, very key, that materiality is important for pricing risks and identifying opportunities, because climate change is not only about risk, it's also about finding opportunities. And then lastly, it's about information, so timely, consistent, accurate, standardized, a very important issue, proactive and long-term. Moving on to the next slide, gives you an idea on, thank you. Moving on to the next slide gives you an idea on what type of disclosure and transparency we require when we are doing our ESG analysis. It's a best-in-class approach. I'm not going to detail too much about this, but in a nutshell, what you try to do is to come forward with those companies that are best dealing with all the challenges and issues that they face from a sustainability perspective. And we have two types of building blocks. On the left side, you find our micro bottom-up, where we look at stakeholders. We have 6, and what you can see with that stakeholders is it's not only about investors as a stakeholder. We broaden that scope to also society, but an important part is also environment from a bottom-up perspective, where we look at production process, energy efficiency, water efficiency, recycling. The most important part actually is the right part, where we look at our macro approach, our business activity exposure. And that is really where we're talking about the materiality of climate change. Climate change is one of the pillars that we have been researching for a very long time. This process is up and running for more than 10 years. So climate change and the other aspect, resource depletions, are intertwined, obviously. But there are two very important aspects that we screen on from a top-down perspective. We're really going to look at how are companies exposed to those sustainability challenges, materiality and exposure. So we're assessing the risks and the opportunities that companies faced based on the business activities that they're involved in. And that obviously leads to a kind of classification or identification for companies in terms of risk and opportunities when it relates to climate change, resource depletion, but also other types of key material sustainability challenges that we have identified. And in the end, and that's what you see on the bottom, you end up with kind of an ESG universe that summarizes the best performing companies based on our two building blocks. Now, maybe a little bit more in detail on the next slide, the last slide I'm going to discuss very succinctly. I'm going to have that focus on climate change. Obviously, climate change is not something that is specific for the energy sector or the utility sector. It's a challenge that faces every kind of stakeholder within all sectors. But most exposed sectors are definitely high impacting sectors. And then we're talking about energy, transportation, materials, mining companies, utility companies. Those are the sectors that will feel probably the most and the highest impact, both from a physical, but also from a transition perspective, when we talk about climate change. So what we're going to do is we're going to look at the impact of their activities, and we go beyond the traditional scope of 1 and 2. So we look at 1, 2, and 3. And we are going to analyze the physical risk and transition risks that those activities are exposed to. And that is going to lead us to kind of an impact measurement in function of the sector, and a ranking of the business activities, and then making the link to companies. And finally, what we're going to do is classify companies based on the business activity involvement and the way those business activities are exposed, that can be either positive or negative, to that climate change pillar. And that way we can identify the best companies and also the worst companies within each sector in terms of materiality exposure to climate change. Making that link to disclosure and transparency, and that's my last point I'm going to make. What we do is we analyze materiality, so we seek information for companies that allow us to do this kind of analysis. So we use key performance indicators. We need input for those analysis, for those indicators. That's why we engage with companies, asking them to have full disclosure on what we require to do this type of climate change and resource depletion analysis. So disclosure and transparency is very important for us to make informed decisions on the physical risk and transition risk that companies face, not only to identify the risk itself, but also to identify the opportunities to make informed investment decisions. Thank you.
Thank you very much, Wim. We've got a question from Kevin, who says, how do you measure the industrial transition to a low carbon economy when industrial classification systems map one industry to one company?
That's a very good question, actually. What we try to do is, obviously, industrial companies are exposed to climate change more from a production perspective. So I'm talking about the emissions themselves, where we actually we have different kind of metrics that we use that relate to the production process itself, the emissions that come from that production process, but it also relates to where those activities, where they have their production facilities, because that obviously exposes them to certain kind of physical risks, and some industrial companies have exposure to emerging markets where those physical risks can be very important. So it's a holistic view that we try to take, trying to approach it from, first of all, the company itself, production process and facilities, where you use clear carbon emission metrics, water emission metrics, recycling processes, what is their strategy and policy. But then, and I refer to my earlier slide on, that's actually the micro part, but then you also look at the macro part, which is actually the most important one from a long-term perspective, where you really look at the governance strategy and policy of a company, where you look at how are they exposed to the physical risk and the transition risks that relate to climate change. Obviously, some industrial companies offer solutions, so that will score very, very well. And obviously, I do not have to tell you that in terms of wind, solar, hydro, this kind of solutions, there are specific industrial companies that have a clear focus on these solutions for climate change. That obviously will score very well in our macro analysis, while others have very negative exposure in terms of the activities that they are involved in.
Thank you very much, Wim, for a very, very interesting presentation and your insights. Now I would like to invite Faith Ward to introduce herself. Faith, would you like to introduce yourself now?
Hi, thank you. I'm now unmuted. So, hello, everybody. Hi, my name is Faith Ward, Chief Responsible Investment Officer at Brunel Pension Partnership and the Co-Chair Pathway Initiative. And both of those, I'll give you some more insights into those as we go along in my presentation. Many people may be more familiar with my name linked in my former role with the Environment Agency Pension Fund. And I'll come a little bit about how that relationship continues going forward as part of the partnership. So thank you for Mustafa and thank you, Win, for an excellent presentation, which I think mine sort of naturally leads on from that sort of asset owner perspective. So, and Brunel Pension Partnership is its involvement as an asset owner, so very much at the heart of being a preparer and using TCFD in that sort of preparing role. And I'm going to give you insights as to how we're looking at how it's going to influence our own operations, how we're thinking about it very much ourselves, and how we're going to support our founding clients in their ability to prepare TCFD kind of disclosures. But we're also going to be an active user of the outcomes and outputs from the TCFD as well. So to bring that into perspective, I shall move on to the next slide. There we go, that's me. So Brunel Pension Partnership, for those outside of the UK, you may not be aware, but the government required that the local government pension schemes within the England and Wales became grouped. And there's these new entities, of which Brunel is one of them, and they were formed in July. And that's going to take over the implementation of the investment strategy of the 10 LGPS founders, or both our clients and our shareholders. So still very much linked to the Environment Agency, and indeed Avon. Both of those clients have made very strong commitments to managing climate change within their investment strategies. The combined assets of these 10 and what we'll have the day-to-day responsibilities for will be £28 billion of assets under management, which to bring it, we're very keen to kind of see this in terms of supporting over 700,000 people's pensions. And I think that link to the beneficiaries and the ultimate kind of owners of these assets will come out in terms of the importance of TCFD, in terms of translating and making people aware of how we're effectively managing those risks on their behalf. As I've indicated, these are quite new entities, these new asset pools, of which Brunel is one, and they will be operational as of April 2018. But Brunel, very much like a lot of its founding partners, is very much committed to responsible investment, being long-term, and trying to put these things and manage them for the long term in terms of all of these risks. So I'm going to reflect both on what Brunel is planning to do, but also my time within the Environment Agency Pension Fund, because the Environment Agency has long been a leader in this space and has been campaigning for better quality and consistent climate disclosures for many years. And in fact, it's one of the first pension funds to make a commitment to work within a 2-degree environment. That was its ambition, to work within 2 degrees, its entire investment strategy. So sort of quite a reputation to live up to in terms of the starting point for which Brunel needs to do. So if I can move to the next slide. Thank you. So I very much structured the presentation around the 4 pillars of the TCFD, around governance, strategy, risk and metrics. So initially, obviously in governance, very important around the ownership, that board level commitment, and very much supporting sort of strategic asset allocation. One of the things I feel that if you actually think of the Taskforce on climate disclosure, you could almost think of it less to do with the disclosure element, but actually it makes for a really good framework in terms of a governance checklist. Have you, as a pension fund, as an asset owner, have you actually considered climate change in this way? Do you have that top level discussions? Have you actually thought about how this might impact on your strategic asset allocation? How does it impact different asset classes? How does it impact different sectors? What are the timeframes in which you're operating in terms of your investment strategy and sort of all the interactions with that? Do you have sufficient training in place to really support that decision making? So those are all things that the Environment Agency undertook and what Brunel is undertaking and supports its clients in doing in terms of thinking about that strategic asset allocation and providing that sort of client support around training. And that then flows through to the scenarios and the strategy work, which is underpinned by sort of scenarios. I think this is probably one of the more challenging areas of the TCFD. I think most people recognise that that's where it's really taking us to a whole new level in terms of our thinking, in terms of climate change and how that might impact on our investments. with the Environment Agency was a member of the Mercer study on investing in climate change, and that very much helped it to underpin the strategy and the work and its policy commitments that it then undertook. Scenarios will also form part of the work that Brunel will be doing, looking at some of the sort of advanced risk analytics that can provide the clients to actually build into those scenarios, and also what we'll be looking for asset managers to be looking at in terms of their scenarios and how their individual funds might be impacted and how they're looking at these over the long term. In portfolio construction, looking at the selection of benchmarks and how that might have an impact on different, particularly on sort of equity portfolios. But also I think it's very important to emphasise that we see TCFD as impacting on all asset classes. I think there's a tendency, partly because of the way some of the tools are currently available, to think of this very much in an equity sense, but actually this is about all asset classes. And I think that becomes particularly relevant when you look at private markets, or where the timeframes for some of the holdings may be very long term. The other element in terms of the strategy is also to make available and to actively encourage sort of the positive investments and to make those opportunities available to the clients of Brunel in terms of the strategies in which they might want to sort of invest in, so positive investment opportunities. Now, next slide. So from a risk perspective, looking at whether climate change is in the risk register, again, something the Environment Agency did, and all the climate metrics were ones that we used to support the decision making. Brunel will be doing carbon footprinting, looking at fossil fuel exposure, looking on the real estate using the GRESB scores to evaluate sort of carbon risk, and also all of these metrics can be used in as part of the sort of due diligence exercises in many instances, and also looking as to how we can do this within sort of private markets. It's a much less developed area than it is within the sort of equity space, but we're work in progress. And again, looking at positive investments again under risk and the benefits that might bring from diversification and other elements of risk, but also sort of tactically. So in addition to strategically providing opportunities for positive investments, there might be investments that fit within also mainstream portfolios as well. Another example that we are making available through Brunel is the use of an enhanced index tracking and sort of where climate is then climate quant, some of the new sort of smart beta tools that are emerging that allow for some of these climate factors to be integrated into sort of the product offering in those both the index funds and also quant products. So finally, and the next one in terms of the TCFD sort of metrics, looking again at then this is more the metrics you use from a sort of reporting perspective, sort of the carbon footprint help you to evaluate risk. We very much look for the asset managers that we'll be appointing to be undertaking carbon footprinting and fossil fuel exposure, but it's about being climate aware and carbon aware rather than expecting all managers to be low carbon. That's certainly not the case. It's about being aware of the carbon intensity of portfolios and how that's sort of factored into the decision making of the whole sort of investment. Metrics within other asset classes, I think, are a lot more challenging. And again, this is an area where we're exploring, but don't have all the answers yet. So are very much looking to sort of work collaboratively with other parties into developing expertise in that area. Then all of this is all about disclosure. That's very much at the heart of what the TCFD is all about, and very much seeing TCFD as a way of underpinning the communications that Brunel undertakes. We'll be using our website extensively to provide both our TCFD disclosures in our annual report and financial statements. Having the TCFD is a disclosure in its own right, but with additional case studies to really kind of bring it to life. We'll be using it on beneficiary communications and enable our clients to share and explain how the day-to-day management of their investments are, being very carbon and climate aware. And I think sometimes that beneficiary angle is sometimes overlooked too often. And this work within the TCFD is part of a broader commitment to embed our reporting within the Sustainable Development Goals and actually see how we could sort of broaden the discussion, if you like, around the sort of broader, and hopefully that TCFD can be seen as a framework that can be used more broadly to consider other social and environmental issues that have material financial impacts on the funds which we manage. So that very much summarises how we're looking at TCFD for supporting our clients, and in particular the Environment Agency and Avon, who have made particular commitments in this space. But we're also an active user of the data that will emerge from TCFD. And one of the other initiatives that we are party to is the Transition Pathway Initiative. And if I can have my next slide, it beautifully illustrates some of the work there. This is just one of the extracts from the online tool. This is an asset owner initiative with over £5 trillion worth of assets supporting it. And it's underpinned by analysis from the London School of Economics and FTSE Russell ESG data. And it provides a free online toolkit for asset owners and asset managers to use to establish what companies have actually disclosed on their sort of carbon and climate related issues, particularly in relation to the transition to a low carbon economy. What we are updating, or have updated in fact, all the indicators that sit behind the toolkit so that it actually will be able to be matched to the TCFD indicators. So it will be very easy then to track where companies are in their disclosures on what factors they have actually shared with the public at large. So the analysis that the TPI has undertaken covers coal, electric utilities, oil and gas, cement and steel, and shortly automotives and pulp and paper. And it very much is very much a tool designed for everyone and anyone to be able to really engage with the transition to a low carbon economy, particularly those that are perhaps finding it difficult to know how to take some first steps in getting their mind around some of the challenges that climate change presents to them in managing their assets. So I've given you a sort of stock Brunel intends to approach and intends to use the TCFD as a framework, and how we tend to use gave us.
Thank you very much, Faith, for that perspective. It's definitely very interesting to hear the views of asset owners. I'm very aware of the time. We do have questions coming in, and we will direct them towards you at the end of this session. I would now like to introduce Jane Stevensen. Jane is Task Force Engagement Director at CDP. Jane, are you there?
Yes, I'm here, Mustafa. Hello.
Over to you.
Thank you very much. Hello, everybody. Thank you for joining us. And I must say thank you to my two previous presenters, who've given us a really interesting and very specific interpretation of how the TCFD recommendations are moving them forward in terms of managing risk on behalf of their organizations or their client organizations. My background is one of having spent most of my career in the corporate world, actually as an exploration geochemist initially in the oil industry, and then moving into the management of fragile environments. And just over 2 years ago, I joined the CDP group, initially as acting managing director of CDSB, the Climate Disclosure Standards Board. And during that period, the FSB's Task Force for Climate-Related Financial Disclosures was launched. And we set out to support its work from its initial launch at COP21, leading up to the publication of the TCFD report and recommendations to the G20 in July 2017. I'm also a member of the Sustainable Stock Exchanges Initiative Advisory Working Group on Green Finance, and I have recently joined the City of London Green Finance Initiative Working Group on Data Disclosure and Risk. So if we could move into the presentation now, Mustafa. I'm actually going to take a bit of a step back. Our two previous presenters gave us some very interesting insights into how they are practically applying the recommendations. But I'm going to take a bit of a global look at what's actually happening at the moment. And there's a real buzz and a momentum around the TCFD recommendations. There was quite a quiet launch back in the summer of last year, and it was what you might call a bit of a reserved release. But subsequently, over 100 CEOs have now publicly supported the recommendations, 250 companies who have to say that they are companies committed to implementing within a 3-year time frame, which we can see through the Climate Disclosure Standards Board's commitment on TCFD. There are 130 investors who have written to the G20 encouraging the consideration of the TCFD's recommendations as input to national disclosure rules and representing over $13 trillion worth of assets under management. They have effectively received substantial support from the broad investor community and also appear to be high on the agenda for the upcoming AGMs of organisations who might be lagging in their disclosure of climate-related issues. Sweden and France have publicly committed to the TCFD recommendations and the implementation of them. And the UK government, through its Green Finance Taskforce, it has established developing the recommendations for the UK and using the TCFD's recommendations as the baseline to develop a set of enhanced climate recommendations for companies who are headquartered in the UK. So if I could go on to the next slide, please. I'm sure everybody's familiar with the background, but I think it's worth just touching on it again, particularly as these recommendations have been developed in such a remarkably short space of time, in effectively a year from launch to of the initiative to the recommendations coming out. The objective to integrate climate-related financial information into mainstream reports, and the membership of that initiative comprising 32 members drawn from across the G20. Could we have the next slide, please? So an industry-led initiative, geographically diverse, although the membership is rather EU and US centric, as you can see by that map. The companies represented across those 32 bodies include data users, banks and pension funds, for example, data of industrial global companies were biochemical, be it on ENI, for example, and a number on the TCFD, the global ratings organizations, S&P, Mercer Investments, and of course the big four accounting firms have had a significant input. So PwC and KPMG, for example, have been working with the task force. And clearly, ultimately, if you are going to be reporting this information in your mainstream financial filings, there will be a requirement to look at that on your annual audit. So no surprise that the big four accounting firms have been taking a very significant active role in helping with the development of these recommendations. Next slide, please. So the four thematic areas are just set out there, but I think Faith's presentation gave us really excellent insight into how those 4 thematic areas have been interpreted by an organization who are using this to develop their own strategy and manage their business and their investments going forward. Mustafa, thank you. So pulling out of the TCFD recommendations, you can see there were 11 core recommended disclosures, which are broken down into these 4 thematic areas of governance, strategy, risk management, and metrics and targets. The governance procedures specify that there needs to be board-level oversight of climate-related issues and management's role in assessing and managing these issues. There has been recognised by the TCFD a climate competence gap at board level, and there are significant initiatives taking place at the moment to provide the enabling environment for boards to be able to close that gap. The strategy facilitates the disclosure of the potential impacts of climate-related issues as strategy and its financial planning, specifically if it is material to that organization's business activities. The strategy primarily focuses on the disclosure of time horizons, the impacts of climate-related issues, and the resilience of an organization's strategy, taking into consideration scenarios, and specifically a 2 degrees or lower climate scenario. And again, as I think it was both the previous presenters highlighted the use of scenario planning as being something that really has changed the way businesses are looking at their environmental issues in terms of the TCFD recommendations. Risk management is the disclosure of how an organization identifies, assesses, and manages its climate-related risks. And the recommended disclosures are broken down in processes for identifying and assessing, processes for managing those risks, and describing how both of those processes are integrated into an organization's overall risk management. And finally, of course, metrics and targets is demonstrating what the organization actually uses to assess and manage climate issues, and incorporates the disclosure of Scope 1, Scope 2, and where appropriate, Scope 3 emissions associated with their business activities. Could we have the next slide, please? The 4 key goals of the recommendations are aimed to ensure that they are adoptable across a wide range of organizations, regardless of what that organization does and where it operates in the world. They should define what exactly should be included in the mainstream financial filings. And it calls on companies to disclose decision users and across the stakeholder spectrum, focusing on climate risk, but also on the business opportunities associated with the low carbon transition that will afford for the business itself. If we go on to the next slide, please. The headline recommendations are supported by a set of recommended disclosures, which are set out in the Taskforce's report, and are supported by guidance for all sectors, but with supplemental additional guidance for certain sectors, such as financial institutions and particularly for energy-intensive sectors. And my next slide just looks at some of those particular sectors. So all organizations with public debt or equity are expected to disclose in line with the TCFD recommendations, but they are meant to be usable by all organizations, even if you're not a publicly quoted company. Now, in CDP's 2018 reporting cycle, we have created sector-specific questionnaires and supporting guidance for 17 of the non-financial sectors identified by the TCFD. When the TCFD initiative was initially announced, CDP made a public announcement that we would be working with the task force and would align with the recommendations that resulted from the work once the final report was ready for use. And so this year, all disclosing companies are able to look at our sector-specific questionnaires and the guidance we've created to support them in understanding those questions. We're also now working very actively on the next reporting cycle for CDP over 2019 to 2020, and we are developing guidance for the financial sectors and questionnaires specific to that. In this year's reporting cycle, that's 2018, organisations that lie outside of the 17 sectors that are on the slide in front of you will respond and be able to respond to our general questionnaires. So that incorporates climate change, water and forests, depending on the organisation and their business practice. If I could have the next slide, please. Scenario analysis is very much the different and new approach, which is really changing the way climate disclosure is being viewed by companies, and it's I think a very exciting way to ensure that businesses are really thinking about looking at the future and what it is going to do to change a company's strategy. It's a strategic planning tool to help an organization understand how it might perform and also how it might be affected in a variety of different futures. It's really taking a very different approach to planning. It's not looking at how we've done in the past. It's considering a different world that we're going to have to operate in. And in terms of strategic thinking, it's looking at the longer term. The business planning time frame has tended to be very short term in the past, from even as short as quarterly over a year to 2 to 3 year planning cycles, perhaps 5 years. This is now making organizations think on a much longer term analysis, looking at 5, 10 and 20 plus years, and also having to deal with potentially complex scenarios and uncertainty, and have a much more flexible approach to what that means for the business. Scenarios are not forecasts or predictions. Scenario analysis is a tool to enhance critical strategic thinking by challenging business as usual assumptions and instead exploring alternatives based on their relative impact and also their likelihood of occurrence. Next slide, please. Many of the financial sector and non-financial groups identified by the TCFD have supplemental guidance for their recommended disclosures. And a core aim of this is to improve the understanding of future risks and to develop resilient strategies going forward. I think a really good way of thinking about scenario analysis in the TCFD recommendations is that this is not now what your business is doing to the environment. It's not actually your environmental impact in that sense, but it's recognizing what the environment is going to do to your business. And it's a completely different mindset that has to be adopted. If we could go on to the next slide, please. CDP has updated and restructured its 3 core questionnaires covering climate change, water and forests to align with the new TCFD recommendations. And we have incorporated the new data points, including scenario analysis. We've created sector-specific questionnaires, as I said before, for 17 of the non-financial sectors identified by TCFD. And this is just drawn out of the questionnaire to show you how it looks in there. And in the 2019-2020 reporting cycles, our technical team are now developing sector-specific questionnaires for financial groups, we're starting with a primary focus on the banking sector. If I could have the next slide, please. And this just shows you how this aligns in CDP's new questionnaires with the 4 major themes of the TCFD. So governance, strategy, risk management, metrics and targets. And you can see on those slides the actual numbers of the questions, which if you are a company which discloses through the CDP platform on an annual basis, you'll recognize that terminology. And this has been cross-referenced with the TCFD and with our technical working groups across sectors and with specific organizations. If I could go on to the next slide, please. Both CDP and CDSB have worked very hard to encourage organizations, investors, policymakers, regulators and other stakeholders to review and to begin to implement the TCFD recommendations. We are encouraging organizations to think about scale and pace in terms of the global tipping point of 2020. We have over 6,000 companies disclosing through CDP, which is growing on an annual basis at a rapid rate. So that is addressing scaling up the implementation of TCFD. And the investors using TCFD knowledge currently represent over $100 trillion of assets under management. If I could have the next slide, please. Global TCFD-driven initiatives are taking place at the moment, and CDSB and CDP are very active members of some of those initiatives. The UK government has the City of London Green Finance Taskforce, there's the Sustainable Stock Exchange Initiative, the Corporate Reporting Dialogue, UNEP FI, and a number of others, all of which have the climate specialists which are listed out there taking part. And my final slide, please. And along with other climate specialists, I'm very proud to say that we have supported the work of the TCFD from its beginning. And this recent statement released by the TCFD Secretariat demonstrates the collaboration between all of us. Thank you very much. I'm very aware of the time, so I may have rushed through that. But I think now we have this section where questions can be answered.
Absolutely. Thank you so much, Jane. A very, very insightful, of course. Now we are going to open the floor to questions. We've had lots of questions coming. I'm also very aware of the time. So I think I'd like to start with a question to Wim, which is TCFD has created a window of opportunity. What is next?
Thank you, Mustafa. Yeah, there's a lot to be done, actually. We talk about the whole frame about disclosure and transparency. But I think one of the most important things that we need to work on within the industry as a whole, and it's not only related to climate change, disclosure and transparency, it relates to all sustainability issues, is starting to work on kind of a standard framework for reporting, taxonomy, and in that regard, and specifically also for climate-related disclosure, I think the most important thing for us, and probably also for asset owner, but certainly for investors, is comparability. Comparability benchmarking is absolutely key. We need to start discussing on the different kind of frameworks, tools and methodologies that are in line with those recommendations, obviously. But for the moment, there's not a clear view on what goes into that type of transparency, disclosure and information. Jane was talking about a very interesting part, which is scenario analysis. And I think scenario analysis is a very key part of disclosure here, a very interesting part too. It's probably more related to the governance and strategy part than to metrics and targets. But in that regard, we need to start thinking about what goes into it, the parameters that have been used for scenario analysis, and obviously materiality is absolutely key here. Materiality and comparability. That's the first thing. Secondly, what I think is also very important is that we need to move away from voluntary disclosure to mandatory disclosure. That's absolutely key, I think. We, as an asset manager, we're not actually able to use the current type of information as it is because it's not comprehensive and it's not reliable. But on top of that, it's not all companies disclose for the moment, which makes comparison and inclusion into an investment process very challenging. So that's the second I would mention. And maybe one of the things that is least mentioned in the whole subject of climate-related disclosure is somehow you need to work to a certain kind of target. And I think that target, Jane actually mentioned it's 2 degrees or even below it. And it's that pathway to that target that is very important. How are you going to achieve that target? It's more about monetization of the risks that we're facing, and then very easily you run up into the most interesting problem is carbon pricing. Is about activity-based impact of climate change. So I think we need to do a lot of work in that regard too on the monetization of those risks, because it's that step that will bring it to life for companies, but also for investors.
Thank you very much, Wim. I've also got a couple of questions that I'll direct towards Faith, but please, everyone, feel free to jump in. So I think one of the questions is, from talking to other asset owners, what do you think the barriers are to widespread adoption of TCFD? And also, are you considering the costs involved?
Was that last one about cost?
Yes.
So I'll take the first one. I think that from talking to other asset owners, I think one of the areas is, perhaps coming from the other side, is the opportunity to further integrate into codes and guidance. I think Jane has sort of alluded to the commitments more broadly, but we need to see that kind of filtering down into things like the Corporate Governance Code in the UK Stewardship Code, guidance that comes from our pensions regulator. So, you know, it needs to kind of be embedded into the mainstream sort of regulators' message and the policy kind of language that's used, so it becomes sort of a common language that we all use in terms of what the expectations are. So I think that would help enormously. I think there's also a bit of concern regarding the auditing and risk, and ensuring that the skills and knowledge are there throughout the industry in order to support this initiative. I think Jane alluded to kind of a bit of a skills gap perhaps at the board level of some of the companies. I think that skills gap is more broadly applicable. I think there is probably not enough understanding of climate change within sort of asset owners, not all asset managers. So I think there's quite a scope of work across the whole investment industry really to up the level of skills and knowledge in this space, and support that with some of the tools that we've outlined today. In terms of the costs, I find that more of a challenging one, because I just think, you know, the costs to us are really from not doing this and not sort of being demonstrating our ability to manage these risks. We found that the more disclosure we provide, then the more confidence our beneficiaries and our clients have that we're managing these issues well. And that actually reduces the management time and effort required to sort of answer more ad hoc inquiries or concerns, and also quite active sort of NGO activity around sort of disinvestment and concerns around there. And then being able to demonstrate you have a programme of work, you have analysed the risks, you are actively engaging with the companies in which you're investing, you are, you know, very much on top of the issue, I think plays very well to actually reducing the cost to you as an organisation. So we're coming at it from more that perspective, I think, rather than literally the sort of the costs of how much TCFD will take to comply with. It feels like slightly the question the other way around, the costs or risks of not doing it.
It's also the legal perspective here that is becoming much more important here. Everybody has a fiduciary duty, obviously. Sorry.
Sorry, Wim, could you repeat that?
I think what Faith was referring to, what is also an important aspect here, is also the legal perspective here. We all have our fiduciary duties. And I think those who might deny or might just ignore these kind of risks, that may all come back to them in the future when things become more real. And the most important aspect here, or the most challenging thing, is that it's pretty intangible for the moment, climate change and how it will impact the business. But I think with TCFD and the 4 aspects that they have mentioned, governance, strategy, risk management, and metrics and targets, certainly from a governance and strategy perspective, I think it's becoming more and more important to start thinking about it, because after a few years, legally you might be exposed if you have not considered climate risk.
Thank you very much. So I'm very aware of the time. We'll just have some closing comments. If you could all take 30 seconds each, just explaining how climate disclosure benefits the disclosures. If we start with Wim.
I think climate change disclosure is very, very important, but it's not only from a risk perspective, I think also from an opportunity perspective. Obviously, the TCFD has clearly focused on the risk part, which is an important part, because certain sectors will usually be impacted. But I do think it's also an opportunity to look at the positive side of climate change, and it's actually all the business activities that offer solutions to climate change.
And Faith?
I think Jane's point about the TCFD's motivation to have decision useful information, I think is absolutely critical. We want good quality comparable information to make good decisions as investors, so that capital is allocated appropriately and the risks managed.
And Jane?
Yeah, I think all of those points are absolutely spot on. But the truth is, without effective disclosure of these risks, the financial impacts of climate change just won't be correctly priced, which will stabilize markets and have a profound effect on the world. And that's something that we simply.
Sorry, Jane, could you repeat that? I think we've lost Jane to.
Oh, sorry, I've got you back. Did you lose me there?
Yes, we did. So I think we're going to conclude our webinar, Disclosure and Transparency to Scale Up Sustainable Investment. Thank you so much, Wim, Faith, and Jane. Thank you to all the attendees. We will send you a link with the recording. You can meet Wim and Jane at the Sustainable Investment Forum Europe in Paris on the 13th of March, and we hope to see you all there. Thank you very much, everyone. Thank you.